Welcome back to another episode of the e-learning series on GFSM, the Government Finance Statistics Manual. In this episode, I will introduce you to the GFS balance sheet. I will discuss related key components, the valuation of those components, and talk about the balance sheet's analytical benefits. Suppose a fiscal analyst is conducting a study of a country's fiscal condition, weighing recent outcomes against the long-term perspective. What data does the analyst need to obtain a comprehensive view of the government's overall financial health? First, revenue and expense data, as well as the respective balancing items from the statement of operations, provide information on recent performance and are highly relevant. But what about long-term perspective? What about government assets, debt and other liabilities and their relation to the fiscal balance? What about the government's net worth and net financial worth? Similar to analyzing a corporation, the fiscal analyst starts answering these questions by reviewing the government balance sheet. A balance sheet presents the value of total assets, what the government owns on the one side, and the value of total liabilities, what the government owes, on the other side. The difference between total assets and total liabilities is called net worth. By analyzing the relation between assets and liabilities, the analyst can gain insights into the long-term fiscal position. Does a government have sufficient resources to pay its debt in case of unexpected revenue shortfalls? How does net worth change in time? Keep in mind that revenue increases net worth and expense decreases net worth. But net worth can also be affected by, for instance, a change in the market values of assets and liabilities, or the destruction of assets through natural disasters, the so-called other economic flows. The statement of operations does not include this important information. Let me explain the components of the balance sheet further. What is an asset? What is a liability? GFSM defines an asset as a store of value representing a benefit or series of benefits accruing to the economic owner by holding or using the resource over a period of time. Assets deliver economic benefits either through income, such as the interest that a loan generates, or by facilitating the production of goods and services, for example, a building that government employees work in. This means a government starts owning an asset only when the benefits can actually be used. The electromagnetic spectrum, for instance, only becomes an economic asset once mobile communication licenses are issued and paid for by mobile phone corporations. Often, the economic benefit depends on technological or scientific factors. Something may become an asset which didn't qualify before. The government probably owns assets such as buildings, land, and computers, and it most likely holds financial assets such as loans and deposits. But through its sovereign powers, it may also exclusively own assets in a country such as infrastructure, heritage assets, or the electromagnetic spectrum. Note that a government's power to impose taxes is not considered an asset. Let's turn to the other side of the balance sheet, the liabilities. A liability is established when one unit is obliged, under specific circumstances, to provide funds or other resources to another unit. As a matter of fact, liabilities mirror the definition of financial assets, except for monetary gold, in economic statistics. This is because liabilities always have a counterpart financial asset or claim. A liability provides the party that the liability is owed to an economic benefit stemming from the obligation. Now let's look briefly at the assets and liabilities categories. There are four main groups of non-financial assets. Each can be divided into subgroups. For instance, an office building owned by government will be classified as buildings other than dwellings, which is a subgroup of buildings and structures. And there are 8 main groups that apply to both financial assets and liabilities. Financial instruments such as loans, deposits held in banks, or equity owned in public corporations can be classified in these different groups of financial assets and liabilities. Assets and liabilities can be valued in different ways. Market value, the value that an asset or liability can be traded for on the market, is a central valuation measure. Publicly traded shares or motor vehicles are examples of assets where the value can be easily determined from daily trading. However, many government assets and liabilities are not traded. For example, loans from other governments or roads. Here the government accountant will look for suitable alternatives for valuation. The road can be valued at what GFSM calls the written down replacement cost. The loan is valued at the current amount outstanding, including interest, the nominal value. Ideally, data are available for market, nominal, and face value. Contingent assets, contingent liabilities and provisions, accounting values that are dependent on some future economic event or condition, do not qualify as assets or liabilities. However, they should be recorded as memorandum items. Implicit social security obligations, such as the future provision of healthcare under a social security scheme, are also not shown on the balance sheet. In practice, the compilation of a government balance sheet is a major endeavour. Countries often compile balance sheets in three broad phases. Debt data, often readily available from the Debt Management Office, are the easiest to collect, and this is typically the starting point for compiling a balance sheet. The next step is expanding to a financial balance sheet by adding data on financial assets, which is usually readily available but dispersed over many sources. With information on both sides of the balance sheet, the fiscal analyst can take a comprehensive look at the country's fiscal position and derive net financial worth, liabilities minus financial assets. The remaining step is to compile data on non-financial assets. This usually starts with an asset register and then an appropriate valuation of the non-financial assets. Governments that have developed such registers often describe the process as treasure hunt. They discover that knowing the current value of assets such as forests, buildings and roads help manage government resources. To conclude, revenue and expense data allow the fiscal analysts to study the short-term fiscal outcomes, including the impact on net worth. The balance sheet goes a step further and provides a holistic and longer-term perspective. The balance sheet links flows with stock positions of assets and liabilities. Fiscal analysts can also derive headline indicators, such as gross debt and net worth and net financial worth from the balance sheet. These indicators add insights into the government's financial strengths, the sustainability of government policies, as well as fiscal risks and vulnerabilities. Who would have thought that GFSM could take you on a treasure hunt? Good luck with that.